Welcome to the deep dive. Ever feel like the legal structures behind businesses are, well, a bit of a maze?
Hmm.
From the corner coffee shop to the huge tech giants, every single one operates under a specific legal framework.
That's right.
Today, we're going on a fascinating deep dive to untangle all that. We want to give you a clear shortcut to understanding these foundational choices that shape, well, pretty much the entire commercial world.
Exactly. Our mission today is to take this seemingly complex world of business entities and break it down into clear, actionable insights. We've pulled together a whole stack of information exploring everything from the simplest solo setup to the most intricate corporate forms. By the end of this, you should not only be able to tell the difference between their core attributes, but also understand the why behind each one.
Yeah.
How those choices impact everything from personal liability to taxes.
Right. So whether you're maybe thinking about starting your own venture or evaluating a company as an investor, or even if you're just curious about how the economy really works, this is your essential guide. We're going to try and shine a light on the legal scaffolding of commerce and maybe uncover some surprising facts along the way. So let's unpack this. Okay, so to kick us off, let's maybe zoom out first. Get a snapshot of the different business entities out there.
Good idea.
What seems really critical to grasp is how different their attributes are. Understanding these differences, well, it seems absolutely foundational, right? It determines everything from legal protection to tax obligations in the real world.
That's absolutely right. And to make that differentiation really clear, we're going to focus on 5 major attributes for each entity type.
Wait, the attributes, okay.
Yeah, think of these as the lenses we'll use to look at each structure. So how it's formed, the extent of liability for its owners, that's a big one. How it's managed, how easily ownership can be transferred, and critically, how it's taxed.
Oh.
If you can get a handle on these 5 areas, you'll be able to, quickly size up pretty much any business structure you come across.
Makes sense. And what better place to start than, well, the very beginning of the entrepreneurial journey, the sole proprietorship.
The classic starting point.
Yeah, this is like the ultimate simplicity in business ownership, just one person, their idea. And what's really remarkable here is the complete lack of formal requirements for actually forming it.
Right.
You don't need to file any special documents with the state just to be a sole proprietor. Maybe, a basic business license for your city or industry, but that's often it.
That simplicity, though, it comes with a pretty significant trade-off.
Ah, okay. What's that?
The sole proprietor faces unlimited personal liability for all the business obligations.
Unlimited personal liability, okay.
Yeah. This means if the business racks up debt or gets sued or just can't meet its financial commitments, your personal assets, I mean everything, your home, your car, personal savings, they're directly on the line.
Wow.
It's the ultimate intertwining of business and personal finances.
Yeah.
And in terms of how long it lasts, a sole proprietorship is totally tied to the owner's life. It can be ended basically whenever they want.
Yeah.
Tax-wise, it's what we call a flow-through taxation model.
Flow through.
Yeah, meaning the business itself isn't taxed.
Yeah.
Instead, all the profits and losses are just reported directly on the owner's personal income tax return. So it simplifies the tax process quite a bit.
Okay.
And if you decide to sell or move on, you've got complete freedom to transfer your business interest however you see fit.
So the sole proprietorship is like incredibly easy to start, offers direct control, simplifies tax reporting. But that risk to your personal assets is huge. Definitely something to weigh carefully if you're thinking about going solo. Okay, let's explore what happens when, say, 2 or more people decide to collaborate on a business idea. That often leads us to the general partnership.
That's a logical step, yeah.
This forms whenever 2 or more persons intend to carry on as co-owners a business for profit. But what's really interesting is that this agreement doesn't even need to be written down, and no state filing is required.
That's absolutely true. It can even be implied just by people's actions.
Implied? How does that work?
Well, imagine Steve and Becky deciding to run a hot dog cart together. Steve buys the cart, Becky handles the cooking and selling, and they agree, maybe just verbally, to split the daily profits. They might never actually say, hey, let's form a partnership, but their conduct, their shared intention to make a profit together, well, that implies one exists legally. And this highlights a really crucial point for anyone venturing into business. A general partnership or a sole proprietorship are the only types of business entities you can form without filing official organizational documents with the state.
Wow, okay, that's a huge distinction. Only those 2.
Yep. Every other entity we'll talk about requires some form of state registration.
So if it's so informal, what about things like joint ventures? Are they basically the same thing?
Joint ventures are legally very similar to general partnerships. They share a lot of the same requirements, the same implications. The key difference really is that a joint venture is typically formed for a um, single transaction or project, or maybe a limited series of them, not usually an ongoing, continuous business like a typical partnership.
Ah, so more project-based.
Exactly. And if there's ever a question about whether people intended to form a partnership, an agreement to share profits creates a really strong presumption that they did. Now, while a written agreement isn't usually required for a general partnership, it does become necessary if the agreement is supposed to last longer than 1 year.
Longer than a year. Okay, why is that?
It's a fundamental legal principle called the statute of frauds. It basically says certain important agreements, especially long-term ones, need to be in writing to be legally enforceable.
Got it.
But the three core elements for a general partnership still remain. You need two or more persons. They have to agree, either expressly or impliedly, and they have to intend to carry on as co-owners a business for profit.
Good to know. So how does a general partnership handle taxes then? And maybe more importantly, how do they operate day to day with multiple owners involved?
Right, so partnerships, while they're treated as legal entities for a lot of things like owning property or suing in their own name, they are not a taxable entity for income tax purposes at the business level itself.
Okay, not taxed directly.
Correct. It means all the profits and losses flow through directly to the individual partners. They then report those on their personal tax returns. It's just a single layer of taxation.
Like the sole proprietorship then.
Exactly like that. Now, as for operating, unless the partners have a specific agreement saying otherwise, all partners have equal rights to manage the business.
Equal rights, even if one person put in way more money.
That's right. It holds true regardless of how much capital they contributed. So, in our Glorious Genes example, if Alex put in 40% of the startup cash and Elias only put in 10%, but maybe Elias is the design genius, they still have an equal say in the day-to-day management decisions.
That's a really significant point. Equal management rights not tied to the money invested. So how are decisions actually made? Does everything need unanimous agreement?
No, not at all. Decisions about things within the ordinary course of business, your everyday operational stuff, only need a majority vote among the partners.
Okay, just a majority for regular things.
Right. But matters outside the ordinary course, those absolutely require the unanimous consent of all partners.
Outside the ordinary course. Like what?
Well, think big foundational changes. Admitting new partners, confessing judgment in a lawsuit, basically agreeing you lost without a fight, or making a fundamental strategic shift, like deciding to sell the entire business.
Gotcha.
So with Glorious Genes, maybe buying more fabric from their usual supplier, that's likely a majority vote, but deciding to stop making jeans and pivot to producing, say, small kitchen appliances, that would definitely need everyone to agree, unanimous approval.
And it's also really crucial to remember that every partner acts as an agent of the partnership.
An agent, meaning?
Meaning they can bind the partnership to agreements through what's called apparent authority. Just by acting in a way that seems normal for the business, they can make a deal that the whole partnership is stuck with. It's very similar to how agency law works in other situations.
Okay, speaking of rights, let's talk about what partners actually own when it comes to partnership property. Is it, like, split equally among them? This is a really common misconception, and it's vital to understand. Partners do not personally own partnership property.
They don't.
No, once money or assets are contributed to the partnership, they become the property of the partnership itself as a legal entity.
Okay.
So if Alex contributes his vintage cars and Becky contributes, say, $200,000 cash to their new business, those cars and that cash now belong to the partnership. Alex can't just take one of the cars out for a weekend trip, and Becky can't dip into that cash for personal shopping.
Right. It's business property now.
Exactly. It's for partnership purposes only. And importantly, personal creditors of an individual partner. They can't just come in and seize partnership property to satisfy that partner's personal debts.
That's a key protection.
It is.
Yeah.
However, a partner can assign their interest in the profits and surplus at any time. They can sell their right to receive monies from the partnership.
Okay, they can sell their profit share.
Yes, but here's a critical detail. The person who receives that assignment, the assignee, does not automatically become a partner. They get the right to the money, but they get no management rights, no say in the business, unless all the other partners consent to them becoming a partner.
Okay. So getting the money doesn't mean you get a vote.
Precisely. And similarly, If a partner has personal debts, their creditors can get what's called a charging order against that partner's share of the profits. It essentially lets the creditor intercept distributions heading to that partner.
The charging order, right.
And if a partner dies, their heirs typically receive the right to the deceased partner's share of future profits, but the actual partnership property, like the cars or the cash in our example, that stays with the surviving partners to continue or wind up the business.
Okay, so partners don't own the property directly, but they do own their share of the profits. What about their duties to each other and their personal liability for what the business does?
That's right. Each partner owes a fiduciary duty to the partnership and to their fellow partners.
Fiduciary duty, meaning
It means they have a duty of loyalty and good faith. They have to put the partnership's interests ahead of their own personal interests in matters relating to the partnership. They can't secretly compete with the partnership, for instance.
okay, loyalty and good faith and liability.
And this is a very, very significant point. Each partner is personally liable for all partnership obligations. All of them.
Personally liable, again, like the sole proprietor.
Yes, but potentially even riskier because it's not just your own actions. This includes not only contracts the partnership enters into, but also torts things like negligence or wrongful acts committed by other partners as long as they were acting within the scope of the business.
Whoa. So if my partner messes up, I could be on the hook personally.
Exactly. Their liability is what we call joint and several.
Joint and several.
It means each partner can be held individually responsible for the entire amount of the partnership's debts or liabilities. A creditor could choose to sue just one partner for the full amount, even if that partner wasn't directly involved in causing the debt or the problem.
That sounds like a huge personal risk.
Hmm.
So how are profits and losses actually split then? Especially if our partners contribute different amounts of capital or, effort.
Well, the rule is, unless the partners have a specific agreement stating otherwise, they have equal rights to share in profits.
Equal rights again.
Yep. And here's a crucial part of that rule. Losses are shared in the exact same manner as profits.
Okay, so if profits are split 50-50, losses are too.
Precisely. So back to Gloria's jeans. Even if Alex put in 40% of the capital and Elias only 10%, if their agreement doesn't say anything specific about how to split profits and losses, they'll split everything equally, maybe 20% each, if there are 5 partners. So if the partnership has a $100,000 loss one year, each of those 5 partners would typically be responsible for $20,000 of that loss.
And what if one partner just can't pay their share?
Then the remaining partners have to make up the difference, usually proportionally based on their own shares.
Ouch. More risk.
Definitely. And one more important detail about distributions. Partners are not automatically entitled to compensation for services they render to the partnership, like, working full-time in the business, unless there's a specific prior agreement saying they get paid.
So no default salary just for working there?
Nope. If Deanna and Elias from Gloria's Jeans are putting in 60 hours a week while others aren't, they wouldn't get a salary or any extra pay for that effort unless the partnership agreement explicitly says they do.
Fascinating. Okay, so what happens when a partner leaves? Or when the partnership itself comes to an end?
Right, so dissociation is the term used when a partner stops being associated with the business. This could be due to them withdrawing voluntarily, death, bankruptcy, maybe being expelled according to the partnership agreement.
Okay, dissociation, does that end the whole partnership?
Not necessarily. Dissociation doesn't automatically mean the entire business dissolves, but the dissociated partner's right to participate in management immediately stops.
Makes sense.
However, their apparent authority, their ability to make deals that bind the partnership, that can actually continue for a while until third parties who regularly deal with the partnership are given proper notice that the partner is gone.
So they need to tell people.
Yes, notice is key. And liability-wise, a dissociated partner generally remains personally liable for any debts incurred before they left unless they are formally released. Maybe through something called a novation, where the creditor agrees to let the old partner off the hook and look only to the remaining partnership.
Okay.
And they can even remain liable for debts incurred up to 2 years after they leave if adequate notice isn't given to potential creditors.
2 years? Wow. What about new partners coming in? Are they liable for old debts?
Generally, no. A new partner coming into an existing partnership is not personally liable for debts incurred before they joined.
Okay, that's a relief for new partners.
Okay.
And then there's dissolution, which sounds more final.
It usually is. Dissolution happens when certain events trigger the start of the winding up process of the partnership's business. This could be a partner giving notice of withdrawal in an at-will partnership, one with no set end date. an agreement among all the partners to dissolve, or sometimes a court order.
So partnerships don't last forever then.
Right. Unlike some other entities, partnerships are not considered to have unlimited duration because any of these events can trigger dissolution. There's a key exception, though. The death of a partner does not automatically cause dissolution if the remaining partners agree within 90 days to continue the business.
Ah, okay. So death doesn't always end it.
Correct. And even after dissolution is triggered, the partnership doesn't just instantly vanish. It continues to exist legally for the process of winding up.
Winding up, what does that involve?
It's basically settling the affairs,
Yeah.
collecting all the partnership assets, paying off any outstanding expenses and debts, satisfying all the creditors, and then finally distributing whatever assets are left over to the partners.
So there's a specific order for that final payout. Who gets paid first?
Absolutely. When a solvent partnership, one that has enough assets to cover its debts, is dissolved, there's a very strict order of payment. First, all creditors must be paid in full. And this category includes any partners who happen to be creditors because they loaned money to the partnership.
Okay, outside creditors and partner creditors first.
Sure. Only after all those creditors are completely satisfied do the partners receive any payments related to their ownership stakes. This happens in two stages. First, they get back their initial capital contributions, whatever they originally put in.
Get their initial investment back.
Exactly. And then, if there are any funds left over after returning contributions, those are distributed as profits, according to their profit-sharing agreement, or equally if there isn't one.
And what if there's a loss instead of leftover funds?
If there's a loss after paying creditors, that loss is divided among the partners according to their agreed-upon loss-sharing ratio, which is usually the same as their profit-sharing ratio, or equally if the agreement is silent on losses. For instance, if the ABC partnership put in $50,000 total capital, but only has $20,000 left after paying all the outside creditors, there's a $30,000 loss. If profits and losses were shared equally among the three partners, each partner would be responsible for covering $10,000 of that loss. They might have to pay that money into the partnership.
And again, if one partner can't pay,
The remaining partners have to cover that defaulting partner's share, usually on a pro rata basis.
that's a lot to take in for general partnerships. Okay, let's shift now and look at how things change when we add that phrase limited liability to the mix, starting with the limited liability partnership, or LLP.
Right, the LLP.
It sounds, similar to a general partnership, but obviously with a critical difference baked into the name.
Precisely. LLPs are indeed quite similar to general partnerships in many ways they operate, like how profits and losses are often handled. But the important differences really fundamentally revolve around that liability protection.
Okay, how so?
In an LLP, partners are generally not personally liable for the acts of their fellow partners, employees, or agents, specifically when those acts involve errors, omissions, negligence, or other kinds of wrongful conduct.
Ah, so protection from your partner's mistakes.
Exactly. It provides a crucial shield against, say, the malpractice or errors of others within the firm, which is why you see them used a lot by professionals like accountants and lawyers.
Makes sense. But are you off the hook for everything?
Not entirely. A partner is always liable for their own negligence or for the negligence of people working directly under their supervision and control. You can't escape responsibility for your own actions or those you're directly managing.
Okay, so liability for your own stuff, but not necessarily your partner's. What about general business debts, like loans or contracts?
Generally, partners in an LLP are not personally liable for the partnership's overall business debts and contractual obligations. The liability stays with the LLP entity itself.
So it's really about shielding personal assets from both partner malpractice and general business debt. How is an LLP formed then? Is it still informal, like a general partnership?
No, that's another significant difference. Unlike general partnerships, which can just arise from conduct, an LLP must file with the state.
Ah, state filing required.
Yes, you typically submit a statement of qualification or a registration document. This formal registration is what actually grants the partners that limited liability protection. And it's interesting, some states actually restrict the use of LLPs to certain learned professions like accounting firms, law firms, sometimes architects or doctors. They recognize the specific liability risks in those fields.
All right, let's shift gears again to the limited partnership, or LP. This one sounds like it involves different classes of partners, maybe with different levels of involvement and risk.
It does, yeah. A limited partnership is a really fascinating hybrid structure.
Yeah.
It has to be made up of one or more general partners
Okay, general partner.
who bear that familiar unlimited personal liability for all the partnership debts,
Yeah.
just like in a general partnership.
Right. Unlimited liability for them.
And then it also have one or more limited partners, and their liability is strictly capped at the amount of capital they've invested in the partnership.
Ah, so limited liability for them.
Exactly, and this is a fundamental point. An LP cannot be formed with limited liability for all the partners. You always need at least one general partner who carries that full, unlimited personal risk for the business's obligations.
Okay, so it's always a mix of unlimited and limited liability partners. Does an LP last forever, like some big corporations might?
Generally, no perpetual life, unless the partnership agreement specifically says it does. In how it's formed, an LP is actually quite similar to a corporation in one key way.
How?
It can only be created by complying with a specific state statute and, crucially, filing with the state. You can't just start an LP informally.
Another filing requirement.
Yes. And the limited partners, they're often seen as being kind of like shareholders in a corporation. They primarily contribute capital, get a share of profits, but typically don't participate in the day-to-day management. To officially form an LP, you have to file a document called a Certificate of Limited Partnership with the state authorities.
Okay, certificate of limited partnership. And how do management and liability work for these distinct types of partners within the LP?
So management is solely the responsibility of the general partners. They're the ones running the show, making the operational decisions, and, as we said, they bear that unlimited personal liability for all the partnership's debts. Interestingly, it's possible for a general partner to also wear other hats. They could also be a limited partner at the same time, or even be a creditor who loaned money to the partnership.
Oh, okay. And the limited partners?
Their liability, as the name suggests, is limited strictly to their investment amount. They generally have no right to take part in management of the business day to day. They're typically not considered agents who can bind the business to contracts.
So they're more like passive investors.
Traditionally, yes. They do retain the right to review financial information, look at tax returns, things like that. Now, there's been a notable update under the more recent Uniform Limited Partnership Act of 2001.
Oh, what's that?
It basically says that a limited partner's participation in management generally does not automatically cause them to lose their limited liability shield. They might even be able to vote on extraordinary matters, like removing a general partner or selling assets, without becoming personally liable. The old rules were much stricter about limited partners staying out of management.
Ah, okay. So a bit more flexibility now potentially, and can they sell their share?
A limited partner can assign their interest, meaning their right to receive profits and distributions. But again, the person getting that assignment, the assignee, doesn't automatically become a substitute limited partner with all the rights unless all the other partners, both general and limited, consent.
Consent is key again.
Yes. And importantly, unlike general partners who owe fiduciary duties, a limited partner does not owe a fiduciary duty to the partnership or the other partners just by virtue of being a limited partner.
That distinction in fiduciary duties seems huge. Okay, what about sharing profits and losses in an LP, and how does it eventually end?
Profit and loss allocation is primarily governed by the partnership agreement. Whatever the partners agree to, that's usually what controls. If the agreement is silent, then profits and losses are typically allocated proportionally based on the value of each partner's contributions.
Proportional to contributions if not specified.
Right. But always remember, a limited partner is never liable for partnership losses beyond the amount of their capital contribution. They can lose their investment, but creditors can't come after their personal assets for partnership debts.
That's the core benefit for them.
Absolutely. In terms of termination, an LP can dissolve based on a time or event specified in the agreement, or by the unanimous written consent of all partners, or typically upon the withdrawal, death, or bankruptcy of a general partner, unless the agreement or the remaining partners decide otherwise. It can also be dissolved by a judicial decree.
What about if a limited partner dies?
Interestingly, the death of a limited partner does not cause dissolution. Their interest usually just passes to their estate or heirs.
Okay. And the order of paying people out at the end?
It's similar to a general partnership's distribution waterfall. First, you pay creditors, and that includes any partners who are also creditors. Then, you typically pay any former partners for unpaid distributions owed to them. And finally, you distribute the remaining assets back to the partners, first to return their contributions, and then any leftover amount is distributed as profit according to the agreement or contribution ratios.
And if there's a loss?
In a loss situation, after paying creditors, Only the general partners are personally liable for making up the shortfall. Limited partners lose their contribution, but nothing more.
Okay, now we arrive at the limited liability company, the LLC. This one really sounds like it tries to take the best bits from partnerships and corporations.
That's exactly right. The LLC is often called a hybrid entity because it offers its owners, who are called members, not partners or shareholders, two really powerful features combined.
Okay, what are they?
First, it provides limited liability for all its members, just like shareholders in a corporation enjoy, meaning the members generally aren't personally on the hook for the business's debts or lawsuits.
Limited liability for everyone involved. That's big.
It is. And second, for tax purposes, the LLC is typically taxed like a partnership by default.
Ah, the flow-through taxation again.
Exactly. Profits and losses flow through directly to the members' personal tax returns. This avoids the double taxation that usually hits C corporations, where the company pays tax and then shareholders pay tax again on dividends. Unless the LLC specifically elects to be taxed as a corporation. They have that option, though most stick with the default partnership tax treatment.
So limited liability and flow-through taxation, that seems like a really powerful combination for a lot of businesses. How is an LLC actually formed and, managed day to day?
LLCs are formed by filing articles of organization with the Secretary of State in their chosen state. Similar to corporations and LPs, there's a state filing requirement.
Articles of organization, what goes in those?
They're usually fairly straightforward. You need a statement saying it's an LLC, its official name, which must include LLC or limited liability company or a similar designation, its registered office address, and the name of its registered agent in the state. And crucially, if it's going to be managed by managers rather than the members themselves, it needs to state that and usually name the initial managers.
Can just one person form an LLC?
Yes. Most states today allow a single person to form an LLC. They're very flexible. As for management, the default rule is that all members may participate in managing the LLC.
So member managed is the default.
Right. If it's a member-managed LLC, then each member generally acts as an agent and has the power to bind the LLC to contracts in the ordinary course of business. However, the members can choose in their articles or operating agreement to be manager-managed.
Manager-managed.
Yeah. In that case, only the appointed managers, who might be members or might be outside professionals, have the authority as agents to bind the LLC. The non-managing members don't have that power.
That's a really flexible structure.
Right.
What about voting power and transferring ownership in an LLC? Is it easy?
Voting strength in most states is proportional to contributions. So if you put in 60% of the capital, you generally get 60% of the voting power on member decisions.
Makes sense.
Similarly, profits and losses are usually allocated based on members' contributions, unless the operating agreement, which is like the internal rulebook for the LLC, not usually filed with the state, says something different.
What's the operating agreement?
It's a really important internal document that outlines how the LLC will be run, the rights and responsibilities of members, how profits are split, etc. Highly recommended, though not always legally required to be written. It can often override the default LLC state laws. Now, a few states that follow the Uniform Limited Liability Company Act actually defaults to equal profit sharing and equal voting rights, regardless of contributions, unless the operating agreement changes that. So you need to know your state's rules.
Good point. And transferring ownership, like selling your share.
That's usually quite similar to a partnership. A member generally cannot transfer all of their interest, meaning their full membership rights, including management, without getting the consent of all the other members.
Consent again?
Yep. Though they can usually freely assign their economic interest the right to receive distributions without consent. The assignee just gets the money, not the membership rights.
Okay. And members can see the books?
Yes. Just like partners, LLC members typically have the right to inspect and copy the company's books and records.
And finally, how does an LLC come to an end? What causes it to dissolve?
An LLC dissolves typically upon the expiration of any duration stated in its articles, or by the unanimous consent of all its members. It can also dissolve upon certain dissociation events, like a member's death, retirement, or bankruptcy, unless the remaining members vote to continue the business. The rules on this vary a bit by state and operating agreement. And, like other entities, it can be dissolved by a judicial or administrative order if certain conditions are met.
We've covered a lot of ground with those more flexible, maybe newer structures. Now, let's step into the realm of what many people think of as the big one, the formal business giant, the corporation.
Right, the corporation.
This one feels like a whole different animal, maybe more complex layers of management and ownership.
It absolutely is in
Yeah.
many ways. The fundamental nature of a corporation is that it's a distinct legal entity, completely separate from its owners, the
It's
shareholders.
separate legal person, essentially.
Exactly. And this means that typically only the corporation is liable for its obligations. The shareholders, the directors who oversee it, the officers who run it day to day, they are generally not personally liable for the corporation's contracts or debts or even most torts committed by the corporation, unless, of course, they personally commit a tort themselves.
That separation is key. What about taxes for corporations?
Right. Taxation is a big differentiator. There are two main types you hear about. The default is a C corporation. It's taxed as a completely separate entity. Its profits are taxed at the corporate tax rate.
Okay, the corporation pays taxes.
Yes. And then if the corporation distributes those profits to its shareholders as dividends, the shareholders pay personal income tax on those dividends. That's the famous double taxation.
Ah, taxed twice. Once at the corporate level, once at the shareholder level.
Exactly. But then there's the S corporation. An S corp is still a corporation legally, but it makes a special election with the IRS to be taxed like a partnership.
So, flow through taxation again.
Yes, the profits and losses flow directly through to the shareholders' personal tax returns, avoiding that corporate level tax.
That sounds way better. Why isn't every corporation an S corp?
Well, S corp have very strict restrictions on who can qualify. They can have no more than 100 shareholders. Those shareholders generally have to be individuals, estates, or certain types of trusts, not other corporations or partnerships usually. The corporation itself must be a domestic U.S. corporation. It can only have one class of stock, though differences in voting rights are okay. And critically, it cannot have any foreign shareholders.
Ah, okay. Lots of rules to qualify for S corp status.
Definitely limits its use, especially for larger or internationally focused companies.
And how is a corporation structured? Who owns it versus who runs it?
So corporations are owned by their shareholders, but they are formally managed by a board of directors. These directors are elected by the shareholders to oversee the corporation's affairs and set its strategic direction.
Okay, shareholders own, directors manage.
Right. Corporations also typically enjoy perpetual life. They can theoretically exist forever, unlike partnerships that might dissolve on a partner's departure. And another key characteristic is freely transferable ownership. Shareholders can generally buy and sell their stock easily on the open market or privately, unless there are specific restrictions in place. That makes investing in corporations much more liquid.
So, a separate legal entity, limited liability for owners, potentially perpetual life and easy transfer of shares. How are these giants actually formed? And how do they fund themselves?
Corporations are uniquely created under statute. This means they must be formed by complying with specific state incorporation laws. Many states base their laws on the Revised Model Business Corporation Act, the RMBCA. But the key takeaway is, corporations are always a creature of statute. You can't accidentally form one.
Always statutory. Got it.
Now, even before the corporation officially exists, people called promoters often play a crucial role. They're the ones who get the ball rolling, procure initial capital, maybe sign preliminary contracts.
Promoters, okay. Are they liable for those early deals?
Yes, promoters are personally bound by the contracts they make before the corporation is formed, unless two things happen. The corporation, once formed, formally adopts the contract, and a novation occurs.
A novation.
That means the other party to the contract explicitly agrees to release the promoter from liability and look only to the newly formed corporation for performance. Without that novation, the promoter can remain on the hook, even if the corporation adopts the contract.
Okay, tricky for promoters. What's the main document for forming the corporation itself?
That's the Articles of Incorporation. This document must be filed with the Secretary of State's office in the state where you're incorporating.
Articles of incorporation, what has to be in there?
The required items usually include the corporation's exact name, often needing Inc., Corp., etc., the name and address if it's a registered agent within the state, the names and addresses of the incorporators, and critically, the number of shares the corporation is authorized to issue.
Authorized shares, right?
What's interesting is what's often not required in the articles. Things like the names of the initial directors, the officers, or the specific states where the corporation plans to operate. Those details often come later or handled in the bylaws.
Speaking of purpose, what about the purpose clause? Is that important?
It can be. Sometimes corporations state a specific purpose in their articles, like to operate restaurants. If the corporation then acts outside the scope of that clause, say it starts buying oil wells, that's considered ultra vires, which is Latin for beyond the powers.
Ultra vires. What happens then?
Directors or officers who authorize those ultra-vires acts can potentially be held personally liable for any losses incurred. Nowadays, many corporations use a very broad purpose clause, like to engage in any lawful activity, to avoid this issue.
Okay. And what about bylaws? I've heard of those too. How do they fit in?
Bylaws are essentially the internal rule book for running the corporation. They cover things like how director meetings are held, officer duties, shareholder voting procedures. They're adopted by the incorporators or the board of directors. But crucially, bylaws are not filed with the state. They are purely for internal governance.
Internal rules. Got it. Now, I've heard this phrase, piercing the corporate veil. That sounds dramatic. What is it?
It is dramatic, and it's a really important concept. Normally, you have that limited liability shield protecting shareholders, directors, officers. But sometimes, courts will pierce the corporate veil. They'll disregard the separate corporate entity and hold those individuals personally liable for the corporation's debts.
When would they do that? It sounds like a big deal.
It is a big deal, and courts don't do it lightly. It typically happens when the corporate form has been severely abused. The main reasons a court might pierce the veil include, number one, commingling personal funds with corporate funds, or using corporate assets as if they were your own personal piggy bank.
Mixing money. Okay.
Number two, if the corporation was inadequately capitalized right from the start, meaning it was set up with so little money that it never really had a fair chance of meeting its potential debts, sometimes called being thinly capitalized.
Not enough startup cash.
Right. And number three, if the corporation was formed specifically to commit fraud on existing creditors, like trying to hide assets from people you already owe money to.
Okay, so abusing the structure, underfunding, or fraud. What does not justify piercing the veil?
Right. It's also important to know what doesn't usually lead to piercing. Simply choosing to incorporate as an S Corp instead of a C Corp, that's fine. Converting a partnership into a corporation, also fine. The corporation going bankrupt, that's a business risk. And as long as it was adequately capitalized initially and formalities were followed, the veil usually isn't pierced just because the business failed.
That piercing the veil idea is super important. It shows that limited liability isn't totally absolute if you misuse the corporate structure. How do corporations typically raise money then?
They primarily use two methods, debt securities and equity securities.
Debt and equity.
Exactly. Debt securities are usually bonds. When you buy a bond, you're essentially lending money to the corporation. Bondholders are creditors, they get paid interest and eventually get their principal back, but they don't own the company.
Okay, bondholders are lenders.
Right. Equity securities, on the other hand, are stocks. Common stock, preferred stock. When you buy stock, you become an owner, a shareholder. You have a claim on the profits and assets after the creditors are paid.
Stockholders are owners. What can the corporation accept in exchange for its stock? Just cash.
No, it's actually quite broad, especially under the RMBCA. The board of directors generally has discretion on setting the price, and stock can be exchanged for pretty much any benefit to the corporation. Money, property, real estate, equipment, even promises of future services or promissory notes. The rules used to be stricter, but now they're more flexible. Okay, let's dive into the rights and duties of the key players inside the corporation: shareholders, directors, officers. Let's start with the shareholders. What are their main rights?
Yeah, what can the owners actually do?
Their primary power lies in their voting rights. Shareholders elect and can remove the directors. They also get to vote on major fundamental changes to the corporation, things like dissolving the company, merging with another one, or selling off most of its assets.
Okay, electing directors and voting on big changes. How does the voting work?
The general rule is simple. One share, one vote. If you own 100 shares, you get 100 votes. But some corporations allow for something called cumulative voting for electing directors. This is particularly important for minority shareholders.
Cumulative voting, how's that different?
Instead of voting separately for each director seat, a shareholder gets a total number of votes equal to their shares times the number of directors being elected. And they can cast all those votes for a single candidate if they want.
Ah, so they can concentrate their votes.
Exactly. It makes it easier for a group holding a minority block of shares to potentially elect at least one director who represents their interests, rather than being shut out completely if the majority holder votes for a full slate.
Interesting mechanism. Okay, what about getting paid? Dividends for shareholders. Do they have an automatic right to get dividends if the company makes a profit?
No, absolutely not.
Yeah.
Shareholders have no right to a distribution or dividend until it is formally declared by the board of directors. The board has the discretion whether to pay dividends or reinvest the profits back into the company.
So it's up to the board.
Entirely. But here's a really critical detail. Once the board does declare a dividend, the shareholders immediately become unsecured creditors of the corporation for that specific declared amount,
Unsecured creditors, meaning?
meaning the corporation now legally owes them that money, just like it owes money to other creditors. If the corporation were to go bankrupt after declaring the dividend but before paying it, the shareholders would stand in line with other unsecured creditors to get paid that amount.
That's a key point once it's declared. Now, I've heard of preferred shareholders. How are they different regarding dividends?
Right. Preferred shareholders have certain preferences over common shareholders, usually regarding dividends and sometimes liquidation payouts. For dividends, there are two main types of preference. Non-cumulative preferred stock means the holders get a fixed dividend amount, if declared, before common shareholders get anything. But if the board doesn't declare a dividend in a particular year, that right is lost for that year. It doesn't carry over.
Okay, use it or lose it for non-cumulative.
Pretty much. But cumulative preferred stock is different, and this is a key concept. If the board skips declaring the preferred dividend in 1 year, the right to receive that dividend accumulates. It carries forward. And the corporation must pay all those missed cumulative preferred dividends, called dividends in arrears, before it can pay any dividends to the common shareholders.
So cumulative dividends have to be caught up first.
Exactly. But remember, even with cumulative preferred stock, no dividend is actually due and payable until the board formally declares it. The right just keeps accumulating until declaration.
Got it. What about stock dividends? Are those actual cash?
No, stock dividends are different. Instead of distributing cash or assets, the corporation issues additional shares of its own stock to existing shareholders, usually on a pro rata basis. These new shares typically come from the pool of authorized but unissued shares the corporation has available.
So you just get more shares, not cash.
Correct. No actual assets leave the corporation. Because of this, stock dividends generally aren't taxed as income to the shareholders when received, and they don't affect the corporation's solvency or harm the position of its creditors. It mainly just divides the ownership pie into smaller slices.
Okay, so preferred shares can offer a bit more security on potential payouts. What other rights do shareholders have besides voting and potentially getting dividends?
Well, they have the right to inspect the corporation's books and records, but it's not an unlimited right.
Oh, what are the limits?
Generally, a shareholder needs to give 5 days written notice and state a proper purpose for the inspection.
A proper purpose? Like what?
A proper purpose is one related to their interest as a shareholder. For example, investigating potential mismanagement by directors to decide whether to file a derivative suit would be proper. Requesting a list of shareholders to communicate with them about corporate governance is usually proper. But wanting the corporation's customer list to use for your own separate retail business, that would be improper.
Okay, purpose has to relate to being a shareholder. What about preemptive rights? What are those?
Preemptive rights give current shareholders the right to purchase a proportional share of any new stock the corporation issues for cash. The idea is to allow them to maintain their existing percentage of ownership if the company raises more equity capital.
So they don't get diluted unwillingly.
That's the theory. However, under the modern approach, like the RMBCA, preemptive rights do not exist unless the Articles of Incorporation explicitly provide for them. They are not an automatic right anymore in many states. You have to specifically grant them in the founding documents.
Ah, opt-in, not opt-out. Okay. And one more, derivative actions. That sounds legalistic.
It is. A derivative action or derivative suit is a lawsuit brought by a shareholder on behalf of the corporation itself.
On behalf of the corporation, why would a shareholder do that?
They do it to enforce a right or remedy a wrong to the corporation when the corporation's own board of directors has failed or refused to take action. For example, if directors breach their duty of loyalty and harm the corporation, but they obviously won't sue themselves, a shareholder can step in derivatively to sue those directors for the benefit of the corporation. Any recovery generally goes to the corporate treasury, not the suing shareholder directly, though they might get legal fees reimbursed.
Okay, so it's different from suing for your own rights.
Exactly. That would be a direct action, where a shareholder sues to vindicate their own personal rights, like the right to vote or receive a properly declared dividend. Derivative is for the company's rights. Direct is for the shareholder's rights. All right, let's shift focus now to the directors. Their duties and authority are really central to how a corporation functions.
Right, the ones elected by the shareholders to oversee things. What do they actually do?
Their responsibilities are broad and crucial. They elect, remove, and supervise the corporation's officers. like the CEO, CFO. They adopt, amend, and repeal the corporation's bylaws. They fix the compensation for management. And they are the ones who initiate fundamental corporate changes, like mergers or dissolution, which then usually go to shareholders for approval.
And they declare dividends, as we discussed.
Yes, they hold the sole discretion to declare distributions or dividends. But this power comes with responsibility. Directors can be held personally liable if they approve a dividend or other distribution when the corporation is insolvent or would become insolvent as a result.
So they have to be careful about the company's financial health.
Absolutely. However, they generally have a defense if they relied in good faith on financial statements or reports prepared by reliable officers, employees, or outside experts like accountants. They also typically have a right to try and recover an improper distribution from any shareholders who received it, knowing it was improper.
Okay. What about their general duties? Are they held to a high standard?
Yes, they owe fiduciary duties to the corporation. These are primarily encompassed by the duty of care and the duty of loyalty, often analyzed under the umbrella of the business judgment rule.
The business judgment rule. What's that?
It's a legal presumption that directors and officers acted on an informed basis, in good faith, and in the honest belief that their action was in the best interests of the corporation. If directors meet this standard, courts generally won't second-guess their business decisions, even if those decisions turn out badly in hindsight.
So it protects them from liability for honest mistakes.
Essentially, yes. They aren't liable for mere errors in judgment, only for decisions that are grossly negligent, uninformed, or tainted by conflicts of interest. To meet the standard, they must act with the care an ordinarily prudent person would exercise in a similar position. They also have the right to rely on information, opinions, reports, or statements prepared by corporate officers or employees whom they reasonably believe to be reliable and competent, or by legal counsel, public accountants, or board committees. This helps them make informed decisions without having to personally verify every single detail.
Makes sense. And the duty of loyalty.
This is crucial. It means directors must act in the best interests of the corporation and not put their personal interests ahead. They cannot usurp corporate opportunities for themselves, compete directly with the corporation, or engage in conflicting interest transactions without proper procedures.
What if a director does have a conflict, like their own company wants to do business with the corporation?
The conflicted transaction isn't automatically invalid. It can be upheld if it's approved by a majority of disinterested directors after full disclosure, or approved by the shareholders after full disclosure, or if the transaction is proven to be substantively fair and reasonable to the corporation at the time it was authorized.
Disclosure and approval or fairness. Okay. Can directors get insurance or be reimbursed if they get sued?
Yes, corporations are generally permitted and sometimes required to indemnify directors. This means paying for their legal defense expenses and potentially judgments or settlements incurred in lawsuits related to their corporate duties. However, indemnification is usually not allowed if the director is found liable to the corporation itself in a derivative suit, or if they received an improper personal benefit or acted in bad faith. Corporations also often purchase directors and officers, D&O, liability insurance.
Okay, that makes sense. And then there are the officers, the CEO, CFO, etc. They're the ones actually running the company day to day, right?
Yeah,
Often the public face.
exactly. Officers are the individual agents and employees of the corporation who conduct the day-to-day operations. They have the authority delegated to them by the board, and often implied by their position, to bind the corporation in its ordinary business dealings.
How are they chosen? Do shareholders vote for them?
No, that's a common misconception. Officers are selected by the directors, and they can also be removed by the directors with or without cause, though employment contracts might have implications. Shareholders do not elect officers.
Directors hire and fire officers. Got it.
Right. And as corporate agents, officers generally have apparent authority to bind the corporation in matters that are usual and customary for their position and the business. Like directors, they are subject to fiduciary duties, care and loyalty.
Yep.
They get the protection of the business judgment rule for their good faith decisions, and they usually have similar rights to indemnification as directors.
Can officers also be directors? Or shareholders?
Yes, absolutely. Officers can and often do serve on the board of directors, and they are not required to be shareholders of the corporation, though many are through stock options or purchases. So just to recap that crucial power structure. Shareholders elect the directors. The directors then appoint the officers, who handle the daily management. Shareholders do not directly elect or remove the officers, understanding that hierarchy is key to corporate governance.
That hierarchy is really helpful to keep straight. Okay, finally, let's look at what happens when a corporation undergoes really significant transformations or decides to wind down entirely. We're talking about fundamental corporate changes.
Right. These are the big major shifts that require very specific procedures, usually including both board and shareholder approval, because they profoundly alter the corporation's structure, business, or existence.
What kinds of changes fall into this category?
There's a helpful way to remember the main ones using the mnemonic DAMS.
Tams.
D is for dissolution, ending the corporation's existence. A is for amendments to the Articles of Incorporation, but only those that materially and adversely affect shareholder rights. M is for mergers, consolidations, or compulsory share exchanges. And S is for the sale of substantially all of the corporation's assets outside the ordinary course of its business.
Dissolution, amendments, material, mergers, consolidations, share exchanges, sale of assets, dams. Got it. Is there a standard process for these?
Yes, there's a general procedure that most fundamental changes follow. First, the board of directors must adopt a resolution recommending the change, usually by a majority vote. Second, notice of the proposed change must be given to all shareholders, whether they are entitled to vote or not. Third, the change must be approved by the shareholders, typically by a majority of the votes cast at a meeting where a quorum is present, though some states or articles might require a higher vote. And finally, if the change is approved, formal documents like articles of amendment or a plan of merger must be filed with the state.
Okay, board resolution, notice to all shareholders, shareholder votes, state filing. What if a shareholder votes against one of these big changes? Are they just stuck?
Not necessarily. For many fundamental changes, shareholders who vote against the transaction often have dissenters' rights or appraisal rights.
Their appraisal rate.
Yes. It means they can demand that the corporation purchase their shares back from them at a fair value, typically determined through a statutory appraisal process, sometimes involving court intervention if they can't agree on the price. It provides an exit strategy, a way for dissenting shareholders to cash out instead of being forced, along with a major change they oppose.
That's a really important right for minority shareholders. Okay, let's touch on those specific M changes, mergers, consolidations, share exchanges. What's the difference?
Right. An amendment to the articles is straightforward changing the rules. For combining entities, a merger is when one corporation absorbs one or more other corporations. The absorbing corporation survives, and the others cease to exist legally. For example, if ABC Corp merges into XYZ Corp, ABC disappears, and only XYZ remains, now holding all of ABC's former assets and liabilities.
Okay, one survives, others disappear. What's consolidation?
A consolidation is a bit rarer now. It's when two or more corporations combine to form an entirely new corporation. All the old corporations cease to exist, and the new entity takes over all their rights and liabilities.
So A plus B equals new C.
Exactly. And a share exchange is different again. One corporation acquires all of the outstanding shares of one or more classes of stock of another corporation, but both corporations continue to exist legally afterward. The acquired company just becomes a subsidiary of the acquirer.
Ah, okay. Both still exist in a share exchange. Do they all follow that DAMS procedure?
For a merger or consolidation, typically the boards and shareholders of all the constituent corporations must approve the plan following the fundamental change procedure. In a share exchange, usually only the shareholders of the corporation whose shares are being acquired need to approve it. The acquiring company's shareholders typically don't vote unless their own rights are significantly changed. There's also a special case called a short form merger.
Short form.
Yes. If a parent corporation already owns a very high percentage, typically 90% or more, of a subsidiary stock, it can merge that subsidiary into itself without getting approval from the shareholders of either corporation or even from the subsidiary's board. The parent board just approves it and sends the plan to the subsidiary's minority shareholders who still get appraisal rights.
Okay, streamlines things when ownership is already overwhelming. What's the overall effect of a merger?
The main effect is that the surviving corporation automatically steps into the shoes of the merged corporations. It takes title to all their assets and becomes responsible for all their liabilities and obligations by operation of law. The merged corporation ceases its separate legal existence.
Seamless transfer of everything. Now, sometimes companies don't want to be merged or taken over. How do they fight that off?
Ah, yes, takeover defenses. Corporations have various strategic tools they can use to fend off unwanted acquisition attempts, often called hostile takeovers. They might try to persuade their own shareholders that the offer is too low. They might sue the bidder on antitrust or securities law grounds. They could arrange a defensive merger with a friendly company known as a white knight.
A white knight, okay.
They can make a self-tender. offering to buy back their own shares to increase the price or consolidate control. Sometimes there's green mail, which is paying the hostile bidder a premium to just go away and sell back their shares. More aggressive tactics include selling off the company's most valuable assets, the crown jewels, to make it less attractive, or taking on a lot of debt, a scorched earth defense. They can also adopt provisions in their articles or bylaws called shark repellent, like staggered boards of directors where only a fraction are elected each year, to make it harder for a bidder to gain control quickly.
Wow, quite the strategic arsenal available there. Okay, and then the ultimate change, termination or dissolution.
Right, termination involves dissolution, which, as we noted under dams, is a fundamental change. It typically requires approval by both the board of directors and the shareholders, or sometimes it can be ordered by a court in certain situations like deadlock or fraud.
And after dissolution is approved.
The corporation doesn't just vanish instantly. It enters a phase called winding up, similar to partnerships.
Winding up again.
Yes. During winding up, the corporation continues its legal existence, but only for the limited purpose of settling its affairs, collecting any remaining assets, paying off its expenses, and satisfying creditors' claims according to their legal priority, and then finally distributing any remaining net assets to its shareholders, usually according to their respective share classes and rights.
Okay, just a couple of quick practical notes before we wrap up. What about year ends for companies? Calendar versus fiscal.
Companies can choose either a calendar year-end, December 31st, or a fiscal year-end, any other month-end, for their financial reporting and accounting. If they choose a fiscal year for tax purposes, they generally need to get approval from the IRS.
Okay. And what if a corporation formed in, say, Delaware wants to do business in California?
If a corporation wants to conduct regular, ongoing, intrastate business, meaning business within another state, not just occasional transactions across state lines, it must typically qualify to do business there by obtaining a certificate of authority from that state's government. In that other state, it's referred to as a foreign corporation. Foreign just meaning out of state, not necessarily international.
What counts as doing business that requires qualifying?
It varies a bit by state, but generally, things like maintaining a physical office, having employees based there regularly conducting the company's business, or owning operational real estate would likely trigger the requirement. Things like merely having a bank account in the state, collecting a debt through the courts there, holding meetings, or selling goods through independent contractors usually do not constitute doing business requiring qualification.
Good distinction. Wow, what a journey. Seriously. From the streamlined simplicity of a sole proprietorship all the way to the complex, multi-layered machinery of a corporation. We've really covered the whole spectrum of business structures.
We certainly have.
We've peeled back the layers on liability. That's a huge one. Management, taxation, and what it actually means to, own a piece of the pie, whether it's big or small. Hopefully, you listening feel much more equipped now to understand these foundational choices that really shape every single business out there.
Yeah, and ultimately understanding these structures isn't just about, memorizing definitions from a textbook. It's really about recognizing the profound legal and financial implications that underpin every single entrepreneurial dream and every market giant we see.
That's a great way to put it.
And it raises, I think, an important question for you to consider. How might knowing these distinct attributes, the liability differences, the tax treatments, the control issues, how might that change how you evaluate a company next time? Not just as a consumer, maybe, but as a potential investor looking at risk versus reward, or maybe as an employee thinking about job security in the company's structure, or even perhaps as a future founder trying to map out your own business journey.
Yeah, definitely something to chew on, for sure. How does this knowledge change your perspective? Great final thought. Thank you so much for joining us on this deep dive into the legal world of business structures.
My pleasure.
Until next time, keep that curiosity alive.